There are 5 big mistakes that so many beginners in the stock market make. Today I'm going to share with you guys what those mistakes are and how you can avoid them. I cannot wait to share this with you guys today. Good day, subscribers! Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about the 5 biggest mistakes that I see so many beginners in the stock market make. When you're just first dipping your toe in the stock market and you're starting to invest, I see these mistakes made all the time, based upon comments I see in the channel section, based upon what I've seen friends and family do, things like that. So I'm going to share those 5 with you. First, just some housekeeping, just so you guys know. Now I am going to start publishing all videos. I'm generally going to do 7 videos a week, 1 each day, and I'm going to start publishing them at 10 a.m. on Eastern Time, 7 a.m. on California time. Now, it's possible I still could do some night uploads every once in a while, things like that, but I'm going to try to at least like 95% of the time stick to that time schedule just so you guys know exactly when these videos are coming out. And also, if you haven't followed on Twitter yet, the Twitter account I started about a week or 2 ago, I'm now posting a picture, a screenshot basically, of what video I'm doing. So if you're following me on there, you can actually see the video before it even comes out the next day. You'll see it the night before and whatnot. Just a thing, and I will be more active on Twitter as the follower account builds and those kinds of things, and you guys come online. So, these 5 biggest mistakes. Mistake number 1 is thinking it's easy. So many people just get caught up in the stock market and see, oh, that stock went up 10% or that stock did good today. Man, it's got to be so easy to make money in the stock market. No, it is not easy. It is certainly not easy to make a lot of money in the stock market. Maybe to get the same gains as the stock market goes up, if you just want to get 8% a year on average, you can just throw money in a market fund account or something like that, or in a general index fund, and then you can just do as good or bad as the stock market does each year. That's pretty easy, yeah. But if you want to try to get 20% a year, 30%, 40%, those type of high gains, then you really need to understand it's hard work. It takes a lot of work. You have to be willing to read through 10Ks, 10Qs, which are long reports. You need to find out recent news on these companies. You need to look at all the financials and dig deep. You need to find out about the CEO and CFO. How reliable are they? What's their track record with the company? You need to find out all this information. And I would say the hardest part of that, it would be okay if you just found that out on one company, but the fact is, you're going to need to sift through 50, 100 companies plus before you finally find a really good one that you want to invest in. Now, some might get kicked out right off the bat because you just see it and it's like, oh man, that's nothing I want to touch. So that one you don't even look far into, but you're going to still look super deep into a ton of companies and then find out you don't even want to invest in that one. So it's a lot of work, guys. I cannot tell you how many hours I've spent over the course of my investing career reading through 10K after 10K after 10Q and looking at all the news for this company, and I decide, you know what, I'm not going to invest in that one. Oh, do the same thing the next night, not going to invest in that one, same thing the next night, and then finally I come across a company I really like a lot and I actually stick my money into. So understand, it's a lot of work if you want to get these great gains. Number 2, listening too much to others. So, in the stock market, it's really important that when you research something and you really believe in a company, you listen to yourself first and foremost on that investment, and if that investment's a good idea. If you listen to too much from the media, like CNBC and Bloomberg and other places, you might end up making a bad choice. Even if you listen to me, like say I break down these stocks every week, and I might start doing it twice a week. For instance, I broke down Netflix a couple weeks ago, right? I said it wasn't a buy. I said it was not a stock for me. It's not something I would invest in. Netflix still went up 20% the next week. It went, phew. So the bottom line is, if you were, say, investing in Netflix and then you saw my video and you said, oh, Jeremy, he wouldn't invest in that, so I should invest in Netflix, and you sold it, that was a really bad decision on your part. So you cannot listen to too much to others. I cannot tell you guys how many times in my investing career that the media and everybody was saying, you know, that stock's horrible, you shouldn't invest in that, blah, blah, blah. And I believed in myself, and I believed that was the right investment decision. And then guess what? I had a great gain on that stock, all because I listened to myself and I didn't listen to them. And also, a lot of times on these channels, they'll suggest a stock, on cable and whatnot, they'll suggest a stock, and that stock ends up going down massively over time. So, and this includes also analysts. Sometimes analysts are so far wrong with the stock, they'll have a buy rating and that stock will just be going down and down and down. And then they wait to bring their sell rating until that stock's already bottomed out. And at that point, it's already going back higher. So first and foremost, trust yourself. Trust yourself over everybody else. If you want to listen to other people, that's fine, but don't listen to them so much that they're the ones influencing your decision whether you buy or sell a stock. Number 3. I see this all the time with so many viewers on this channel. You guys get infatuated with short-term fluctuations. Short-term fluctuations in price. If, say, a stock I cover goes down a lot one day or up a lot one day, you guys are like, oh, what's going on with that stock? Is it going to go back up? This and that. And you cannot if you're a short-term trader and you're a day trader, then absolutely, that's stuff you got to pay attention to. For my style of investing, which is long-term investing, a short-term fluctuation is nothing. Big deal. If I invest in a stock and it goes up 10%, great. Okay, who cares? If it goes down 10% in the short term, who cares? It doesn't matter in the short term. All that matters is in the long term. That stock had a great gain for me. If a year, 2 years, 3 years down the line, that stock's down or even just barely up, then we have an issue. But if something happens in the short term, if it goes up 10%, I'm not like, yay, I'm the best ever, I'm the greatest investor in the history. No. And the same thing if it goes down 10% a couple weeks after investing, I'm not like, oh my gosh, I made such bad decision, I should quit investing. Short-term fluctuations happen. Don't pay them any mind, other than maybe if it goes down a lot and you still believe in that company, maybe you want to buy some more. That's something I do when a stock goes down after I invest in it. Number 4. Getting emotionally attached to a stock. A lot of beginners in the stock market also, and even some more advanced investors, they get too emotionally tied to a stock. They fall in love with that stock so much that if someone says something bad about it, they get so offended and they want to cuss that other person out and that other person's a devil and this and that. Understand, a stock is a money sign. A stock is a money sign, nothing more and nothing less, guys. It's a way for you to make money. So don't get emotionally tied to that stock, because at some point you're going to need to probably sell that stock, unless it's such a great company that 50 years from now it's worth 50 times what you invested in it or whatever. Most of the times you're going to want to get out of that stock and then go into something else. So there's no point in getting emotionally attached to a stock. Don't fall in love with the stock. Number 5, thinking about macroeconomics. This is something that I see all the time as well, thinking about macroeconomics or political risk. So for instance, in 2011, 2012, 2013, there was so much talk from the media when I would watch these news channels and whatnot, that they would have guests come on, they're talking about double dip recession. And oh my gosh, we're going to go into a double dip recession and oh, the economy is going to fall and we're going to go, things are bad and this and that. Well, if you listen to that and you stayed out of the markets, and they were saying, stay out of the market, be defensive, be in gold or whatever, you would have gotten killed. You would have lost so many gains, because guess what? 2011, 2012, 2013, those were phenomenal years for the stock market. Go back and look at the chart and look at how much the markets went up. Never mind how much so many individual stocks went up. So paying attention to all that crap is you need to just block it out, in my opinion, unless you have unless you're a genius and you're psychic and you know absolutely this next year the economy is going to go into recession for sure, unless you're 100% sure in that, which I don't know anybody who's ever been right about that. No one ever. So, because generally when something happens in macroeconomics, it just comes out of nowhere. Another one is the political risk. Someone says, man, if that person becomes president, then the stock market's going to tank. And if that person does it, we're going to be in depression and all this stuff. Guess what, guys? The United States of America, any idiot can run it. That's the truth. Any idiot can run it and we'll still be just fine. Now, we might be better off with some than others. But the bottom line is anybody can run the United States. You look at, so many presidents that are hated now that ran the country, and guess what? We still did all right. We still did all right. The United States kept going forward. And that's true for most of the developed economies. Sometimes you just get someone bad running it, but everything still works out in the end. It's not like, oh, it's doomsday or something like that. So try not to pay too much close attention to the macroeconomics. Try not to pay too much close attention to the political risk and all those kinds of things, guys. Thank you for watching so much today, guys. If you have not subscribed, you may want to. I talk a ton about personal finance. I talk a lot about entrepreneurship. I'm an entrepreneur and business owner, so I give a lot of tips on that. And talk the most about stock market on this channel. Thank you, guys, and have a great day.